Joining us now is Kevin Giddis, the head of fixed income capital markets at Raymond James, and Julian Emanuel, who is chief equity and derivative strategist at BTIG. How much is riding on this number today? I feel like there's a little less buildup than we've seen in some past years because we're already thinking about what the Fed's going to do next.
So today is less about what the actual number is going to be and more about how the market is going to react to that number. Because what's changed this week prior to the last several weeks is that, what we're realizing is that confidence matters. We really found that out. You had weak confidence surveys of the last several weeks. Then all of a sudden, you had a stronger ISM number yesterday, backstopped with the restart of China talks. So what we're looking for today is even if you get a number that's slightly below expectations, the bond market still sells off, and actually the bond market selling off is a vote of confidence.
Yep.
It's the most important confidence barometer there is right now.
Don't tell me you're back over 3,000 on the S&P. Are you back over 3,000 on the S&P?
It's been the number for a year.
You were definitely waffling the last couple times you've been on. Waffle. A large waffle.
We will wait to see what happens.
You back to 30. You were really bullish at one point, and I thought it took nerve to do it. You were like 3,200 possible, right?
So
is 3,200 possible?
Yeah, it is absolutely possible. Okay,
on the
because it's absolutely
possible. Is 2,500 possible?
No. We don't think so. No, because the economy is... Look, the ISM yesterday told you that, if anything, we're setting up like we set up in the first quarter of 2016. There is a manufacturing slowdown, clearly, and clearly it's a result of the trade war. But the consumer is still there. And that's why, if you look at the last week, the fact that the confidence numbers slipped a bit, the Fed knows it, the president knows it. Confidence turndown has preceded every recession, and they're not going to allow confidence to slip.
Kevin, what about you? You think 2,500 is possible?
Well, anything's possible, right? So I do think, though, that from the bond market's perspective, today's number is more about average hourly earnings than it is about the actual jobs number, because that's what this story has been about for bonds for the last 6 to 9 months. And it's an inflation story, or a lack of inflation story. The Fed has struggled trying to reflate the economy. They continue to do so. This started way back in November of 18 when the Democrats took the House, sped through the Fed, blinking, onto the trade, and here we are today with whether it's 150, 170, or 130. It's more about whether average hourly earnings are going to be up 0.2 or 0.3, and what does that mean for inflation?
I think that's important. I think we can make economics, hard as it is, harder than it needs to be. It's about jobs, it's about income, and it's a bit about confidence, but I think confidence is the least important of all of them. Because at the end of the day, what you spend is relative to what's in your paycheck, plus a little bit sometimes, of course.
Interesting.
And how much that income is growing. With something on the backside of that is your confidence in your job. Mm-hmm. And that's why among the things that I think are most important when we do our All-America survey, when I look at the confidence surveys, it's people's confidence in their job, right? If you think you're going to lose your job tomorrow, or you see people around you losing your job, that changes your reality. I think the trade things are important for CEOs, and they're important for planners, and important, but I think less so for average Americans than the employment level and their confidence in their job and their paychecks.
That's a pretty big ocean liner to turn around from where you see some of your coworkers losing their jobs. You start thinking, well, could that happen to me? Well, could that? I mean, that's like why it's a lagging thing. But I mean, it could happen.
During the crisis, Joe, we did a poll. I'm sorry, I can't remember the number, but it was a very large percentage of Americans who had either lost their job or knew someone who lost their job. And that number has come down.
But from 3.5, it seemed like you might have some warning that that's starting to happen.
Yeah, you would.
Once you got to 4.5 or 5.
You would. And look, all the surveys are telling us, the Beige Book on, what was it, Wednesday, the NFIB that I just quoted today, that the issue of finding workers remains the biggest problem.
That's really interesting, because everybody we talk to is it business is slowing down, or is it they just can't find workers?
I want to give our guests a chance to talk, but I will say the thing we're looking for is the uncertainty from trade that has affected capital spending bleed over into the uncertainty over hiring. We have not seen that yet.
Kevin?
I talked to a taxi driver the other day about the the declining cost of medallions in particular, and you can blame part of that on Uber. But the other thing he blamed it on was in good economic times, those values go down. The only way that medallion prices go up are when we're in a recession, when people who lost their jobs now want to drive taxis. And I thought that was an interesting point about
or if that new regulation in California goes through.
That's like the McDonald's question. Are good McDonald's sales because things are bad,
or
people
Walmart.
need cheap more, or good because they're going out to dinner?
Walmart, same thing. They do well in good times. They will do well in bad times.
So I'm going to bring this back to confidence with apologies
okay,
here.
That's all right.
Because what's very unique about this cycle is we're looking at a 3.7% unemployment rate, okay, and yet the savings rate, the personal savings rate is very elevated, and balances in money market funds have been skyrocketing this year. That is more sort of like, more of a hunker down than you would expect.
But these are also people who lived through the Great Recession.
Right, and we're certainly but what we're going to want to see is the restoration of the confidence that we think ultimately is going to unlock that money and drive the consumer forward and ultimately drive the stock market higher.